I'm Raine Musñgi, and welcome to Follow the Money, where we guide you through the complex world of finance to help you make informed decisions about your money. Today, we're diving into a topic that impacts millions of Filipinos. That's debt management and the path to financial independence. Now, whether you're struggling with debt or seeking strategies to stay debt-free, this episode is for you. We're honored to have with us Rienzie Biolena, president of Wealth Arki, a leading resource in personal finance who has helped countless individuals break free from the chains of debt and achieve financial independence. Rienzie, thank you so much for joining us. We appreciate you being here at Bilyonaryo.
Pleasure to be here.
Now, as an expert in debt management, what has been your success rate at helping people resolve their debt issues? And can you share with us some of the significant cases that you've handled so far?
Yeah. Well, we've had a fairly successful run in terms of our clients with their debts. So a lot of our clients are into consumer loans. So for example, we've had one client have so many loans in so many banks, okay? But the issue there is that she's so very helpful even with her relatives. And I think this would be resonating with a lot of our audience right now, that they'd be helping relatives, families, friends, and she's into those debts just to help other people. Now we've consolidated it into one financial institution which has the lowest interest rate, and then so we've saved up significant amounts of money for her on that one.
Now, ING Bank has actually come out with a study released in February this year, and it highlighted a few interesting findings about consumer spending. If we can just pull up that graphics, we can read through them a little bit, basically highlighting how, you know, after the pandemic, we've already seen that, revenge spending has made a rerun. And it's not just the big ticket items that they're spending for now, but it's also just the basic, monthly, weekly, daily spends, basic goods, groceries, and things like that, utilities. What does that tell us about the kind of consumer spending habits that the Filipinos have? And as long as you have a credit card, you're really going to spend. You're not putting money into savings. What does that tell us about Filipinos?
Well, first and foremost, I think that in order to get to your financial goals, you have to have that savings first. But before having a saving, you have to address that debt issue first as well. Now, in terms of the since the pandemic, well, inflation has been at a historical high. And then, look, for example, for groceries, for fuel, so even for electricity, inflation has been at historical highs. So I think that economically speaking, Filipinos have a much harder time coping in terms of paying their bills. That's why we call that bridge financing, just to bridge that monthly bills, for Filipino consumers. And as well, I think that it has also been a challenge because ever since the pandemic, a lot of jobs have been furloughed, a lot of downsizing or right-sizing even. So the economic impact of the pandemic still reverberates even after that. And even with the inflation that we've had, like for example, in terms of China, in terms of the other logistical infrastructure globally, then given that there has been some glut which already pushed prices even further, not to mention the recent geopolitical tensions that we've had with Russia, Ukraine, and Middle East as well, which also further drove prices up, which, in terms of the value for money, Filipinos really had a challenge. That's why we saw that in the behavior in terms of bridge financing and loans with their needs.
Right, and off-air we were already talking about some of the most common forms of loans or debts that people get into. Can you share that with us?
Well, for example, bulk of the debts would be consumer loans. That's one. Another would be motor loans, which comprise of the automobiles and then the motorcycles. Of course, you have there as well the residential loans, like for the condos, house and lots, lots as well. You also have salary loans, of course, from the companies, right? And also other loans as well. Now, interesting, credit card loans comprise just about 13-14% of the total portfolio, while half of the loans are consumer loans. And these are just statistics from the Bangko Sentral ng Pilipinas. You still don't have the loans from cooperatives because cooperatives as well give loans. You also have mutual benefit associations that's also giving out loans for consumers. And of course, those other informal, informal, should we say, bodies like the 5-6, and other perhaps more informal, like even family members could be a source of loans as well.
Right. There's been apps right now that people also resort to. We have the likes of course, they're using it not just for utilities, but also for not just for their bills, but also for groceries as well as basic needs or maybe a shopping addiction as well. In your experience, have any of your clients actually gone to you and said, Rienzie, I'm this much in debt with this app, and the interest rates have been so cutthroat.
Well,
would you be able to share with us what's the typical amount of debt your typical client would be into, and how long it would take to actually resolve that kind of
Well, our typical
debt?
client would be around 100,000 pesos in debt. Well, it ranges in terms of bridge financing, but some of our clients were into debt because of helping, like for example, this one case, she was helping her father for his medical needs. And we also have another client who's deep into debt just because of consumer finance. Like they would just use their credit card for travel without any fund, So given those things, we've been fairly successful in consolidating their debt and, of course, helping them look for the lowest interest rate loan that's available in the market. Sometimes if they're affiliated with a company or an employment, we just say to them that, just take out a loan. Like, for example, a typical salary loan would cost you around 8% per annum, But a credit card, for example, would cost you around north of 36%. So given that consolidation, that a transfer of loan from credit card to the company would already give you savings in terms of interest rate. Not to mention the apps that we have right now, they charge like what, 1% per day or per week even. So in terms of the compounding, they charge even more. Luckily, a lot of our clients are not into those because we give them proper advice and we advise them as well not to go into those high interest bearing facilities.
So this is a possible solution. You're saying that if you get a low interest loan to pay off the high interest ones, such as the ones in credit card, that is acceptable, and it can actually be manageable over a period of time. But another thing that you brought up is that one of the reasons people get into loans in the first place was because a close relative actually got sick, and high cost of actually paying for hospital bills and medication. Would you say that this is the number one or maybe one of the top reasons people get into debt?
Well, it perhaps would be one of the reasons, but really the top reason would be consumer loans. So those would be the general loans, like for example, constructing a house, or perhaps some renovation for their house, or even like for gadgets. There's this one client of mine, it's a cooperative, and I was just surprised that whenever a new line of gadget or a new model of, like for example, an iPhone or an Android comes out, the loan spikes. And this would be for the gadget loan. In fact, one of their new products is a gadget loan. So I think that a lot of loans would be in this regard for bridge financing, for financing their consumer needs like gadgets, groceries as well. So I think that day-to-day needs would be number one source of, and for the needs of the loan.
Right. So I wanted to ask you, and you touched on this a little bit earlier with the mention of inflation. You know, of course, recent economic environment, you have higher inflation and higher interest rates, which is why, and a lot of people, you know, older people probably won't see it this way, but like, of course, the boomers would say, oh, I was able to afford my own house, you know, in my time, how come you can't afford yours? Why do you have to live in my house an extended period, right? So what would you say to people when it comes to managing your loans? You cannot just be, you know, managing your 20s, your 30s, and continuing to be in debt. What would you say to them?
Well, of course, you have to prioritize. Like, for example, what would be your financial goal? Like, for example, if you're gonna be married, then would you be having a condo? Would you be purchasing a house and lot? And then from there, plan your purchases. Like, for example, you also want to have your automobile, right? You also want to have your pregnancy fund, and then, and then from there, you would have to plan either your emergency fund, your fund build-up, or your loan as well. For example, if you want to have your own place, then plan your housing loan. If you want to have your own automobile, then you can have your automobile loan. But then again, know the figures and then know the numbers. For example, in terms of interest rates, you know, you have to know the interest rate regime or cycle. Right now, luckily, we are in a lowering cycle of interest rates. Interest rates have been at a historical high. So right now, we are lowering. So from the Fed, even the Banco Central, we're lowering rates right now. So it would be good for loans. But if, for example, if inflation was high, then the interest rates would be higher, okay? So that may be not a good time to take out a loan. So right now, I think that by and by, you can go for loans right now, borrow for your big ticket item purchases. And if, for example, you'd be having that home loan, go for the yearly repricing, because you can choose and lock in at a certain interest rate. You know, for example, typical would be every year, every 5 years. So given that interest rate regime right now, which is lowering rate cycle, then I would suggest that they would have that yearly repricing, because if they lock in at a high rate for 5 years, then there's your cash flow.
Great advice right there. And actually, before we go on break, I would like to ask you already, like, you know, of course, ideally, people have savings before they actually make a big ticket purchase. But when does it become less, when does it give you less returns when you pay in cash than if you take a loan? We'll answer that after the break. We're taking a quick one. Follow the money. We'll be right back. Stay with us. Welcome back. You're still watching Follow the Money. We're still with Rienzie Biolena, president of Wealth Arki. Rienzie, like off air, we were already talking about what would be better to pay in cash. For example, you wanted to buy a car, you have the savings for it. And if you pay in cash, you would get a discount. Would that be better than if you just got a loan with, let's say, also some discounts? But you have to pay it off over 5 years.
Well, actually, that's a very good question, you know. For me, we have to go back to the financial basics. Like, for example, one would be emergency fund, okay? So at least 3 to 6 months worth of your expenses should be there. Now, if faced with that purchase, and that purchase would eat up your emergency fund, then I would say no. Because again, you cannot, I mean, after COVID, even with all of these wars going around, geopolitical tensions, you'll never know what would happen in life, right? So you have to have that emergency fund. So if that would eat up on your emergency fund, then I would have to say no and then go for a loan, all right? Even for condominiums, because I'm also a firm believer of using other people's money. Like, for example, I have this condo somewhere in the south, and then my plan was to take out a loan, okay, and then to rent it out. And we call it gearing. And when you say gearing, it's desirable to be positive gearing. So, for example, I take out a loan, I pay the bank like 10, 12,000 per month, and then I can rent it out 24,000 per month. Then that's positive gearing. So yeah, I'm a firm believer of using other people's money for that. But then again, the catch would be your cash flow per month. If you're still on a positive even after the loan, okay, and then living comfortably, then I would say it's a good one. Now, in terms of other loans, like for example, gadgets or even laptops or even a beautiful LCD TV, okay? My tip there would be do not purchase that thing if you don't have the money for it. For example, a MacBook, for example, okay, 56,000, 60,000 pesos. Now, if you'll be using your credit card to purchase that and your bank balance is zero, don't go for it. Unless you can use it for work or even for social media, which would redound to income for you. But if, for example, you have that 60,000 peso in the bank and then, you just don't want to carry out cash because it's risky, then yeah, go for it. Use your credit card, okay, earn some points, some mileage as well, and then after the bill has been paid, the bill has come in, then use your cash to pay that credit card bill.
Yeah, otherwise we should just be building our savings. Abroad we have a sense of credit score rating, right?
Yes,
But here in the
yes.
Philippines we don't. Actually, sometimes we do. In the banks,
Yes,
they
they do
give
have.
you a credit score rating depending on, the documents that you've actually submitted. So if, for example, you're beset with a lot of debt already, some people have multiple debts.
Yes.
Right? So, and you did suggest that perhaps there's a low interest rate debt, that loan that they can actually acquire to pay off the rest. The problem is, would you be qualified for a low interest rate debt in the first place? If you had to advise somebody who's about to get out of a debt or who's about to get a loan, how do they build up their credit score so that the banks would immediately be able to accommodate them when they're requesting for a loan?
Yeah, well, actually, that would be just having that good financial behavior. So, for example, if you have a credit card relationship with the bank, then pay at least the minimum. But of course, I don't suggest just to pay the minimum. And you know what? The landscape right now is very, very much competitive. That's why banks are even calling clients to transfer their other balances to their own bank. So I think they'd be more lenient in that regard so that they get the business of the other banks into them as well. Of course, when you're in that bank already, just be diligent in paying the required amounts, and please don't just pay the minimum, because I saw one study, if you just pay the minimum amount, it would just take you like decades just to pay off your debt. So please pay more than the minimum, and then there are other debt management strategies which I think we can talk about later.
Right. Well, one of the things that I liked about what you said was that you are a believer in using debt to your advantage,
Yes,
right? So,
that's
for
right.
example, this is especially true for properties. You borrow, you rent it out, and your rental will actually pay for the property. But what if, how about, how many people can actually do that? And how else can you leverage debt as a tool to actually grow your income?
Well, actually, in terms of real estate, admittedly, there's a high wall, okay? Or because, when you purchase real estate, like 20% down payment for a 1 mil piece of property, that's already 200,000 pesos. But in terms of SMEs, in terms of microfinance or entrepreneurs, they can also go for cooperatives or even some for mutual benefit associations that do offer loans in that regard. And then, you know what, a funny story, I know one cooperative, market-based, so the primary clients are market vendors. They're a billion co-op. It's a billion cooperatives in terms of assets. So just imagine a cooperative which has market vendors as clients as big as 1 billion pesos. So I think those other, should we say, institutions could help entrepreneurs and other people who would want, financing for their business in terms of coming across their financial goals.
Right. Well, as a final note, perhaps you can share with us what is the ideal income to investment to debt mix in your life? Is it 60-40? Is it 60-30? tan, that kind of
Yeah.
thing, just so you can make sure that not only are you going to be debt-free, but
Yeah.
also grow your investments, grow your income towards a financially secure future.
Yeah. So I think that apart from being debt-free, we should also be thinking of being financially free, right? So debt should not be more than 20% of your income, and limit it at that. If you can't afford it, then just defer it, because that 20%, that would be your limit, and then the remaining 80% you will build for your future, for your family, for your partner, or even for your own self, for a healthy retirement, for all of your travel goals, your business plans in the future as well, other big ticket items or purchases. So 20% would be the limit. Otherwise, you would have to defer it, or, do some garage sale.
That's actually great advice. I mean, if you can't afford it, just don't for the meantime. Well, I'm sure a lot of people would want to be debt-free and financially free and consult you later on. Of course, you're available on the YouTube sites as well as other social media. Thank you, Rienzie Biolena, President of Wealth Arki. We appreciate you being here and sharing with us your insights.
Thank you.
And before we go, we leave you with this final thought from American financier and investment banker John Pierpont Morgan, JP Morgan. Often, the real reason for paying off debt is to regain control over one's financial destiny. And that's it for today's edition of Follow the Money. I'm Raine Musñgi, and thank you so much for watching. Keep it here on BNC, the Bilyonaryo News Channel, always on top.